G'day everyone, welcome back to Pete's Investing. Today we've got a strategy video showing you the CCI350 with a weighted moving average of 100, trading on a daily time frame for shares. Now again, I'll put some basic rules at the end of the video to follow in terms of which type of shares to buy, and we're only going long in this case, and we're using the average down approach. So in this example, I'm just going to show you, this is BHP, this is the weekly chart, and this is the daily chart. Up here is the profitability chart for BHP over the period back tested. This shows the number of contracts entered at any particular moment. So this goes back to, December 1998. So I've back tested it to that period, and I've gone back that far just to show you, and this trades throughout the whole period. And I'll explain what I mean by that in a minute. You should be only trading in a long when the CCI is going long, i.e. when the share price is also going long. So I've back tested back to back to 1998, because we want to take into effect back in 2008, for example, the GFC. There was a slump during that period there. There's also another slump during COVID and recovery and so on. So I'm showing you the full history of the back testing and how that affects the drawdown of averaging down when you buy and sell these shares. So without further ado, let's go and drill down to the strategy and what that means. So I'll show you first of all trading with a single entry. So if you enter in a trade there, that's where it enters the trade and that's where it exits the trade. So the entry parameters are, and down here I've got the CCI350 with a weighted moving average of 100, and that's that green red line there. So the CCI350, you can see there the jagged line. The way you enter it is when the moving average is going long. So you don't enter it when it's going short. You only enter when it's going long. So when the moving average is going in upward direction, and also when the CCI350, the jagged line, the black line, is above the moving average. So you can see there, it just broke above, the moving average just broke above, and it would have just broken above that moving average. So you enter a single entry there. So again, we're trading a number of shares here. We're trading $2,000 lots. So we buy $2,000 worth of BHP at that point there. Now you'll notice the price goes sideways and then drops down here until it finally closes out there. Now why am I closing it out there? Because the close parameter I'm using is when this histogram, when the CCI350 breaks below its moving average, and also the close at that point is greater than close it. And close it is a calculation I use, and it looks at the previous 90 days. So let me just drill down here. The previous 90 days, the highs and lows. So the close is greater than that average of the last 90 days, of the high-low range of the last 90 days. So the simple way of measuring is, if you draw a trend line, let's say from there to there, just very broadly drawing a trend line, and from there to there, oops, that's not a vertical. Let's draw a diagonal trend line, let's say from there to there, and we measure the high-low range from there to there. We get that range difference. So it's about $4.68 is the difference. So what you're looking at, we're a 14% difference. So what we're looking at doing is, if I move that as an example, so it's gone beyond that range. That's where I close it. So the first parameter is the CCI 1500. The CCI drops below its moving average, which it did there, and the price is greater than that average of the last 90 days, the high-low range of the last 90 days. And that's just a ballpark calculation I used just on that little example I've demonstrated there. So you'll notice the CCI broke below its moving average there, but the price wasn't quite high enough according to our exit parameters. Now, that's a bit complicated probably for you, but the other way you can do it is if you drill down on that area there. Let me get rid of these diagonal lines just to make it a bit clearer. Another example you could use, which is quite reasonable, is applying a 5% gain on your price. So if you entered it there, you could exit it after a 5% gain. So you would have exited there. That's another way of doing it. Get out with a 5% gain. Don't be greedy. That's also a benefit. But I've used the average high-low range of the last 90 days in this back testing to show you the benefit. Now, that was just a single entry of a contract. Here I want to show you a multiple average down approach. So what we're doing here is we're applying the same entry parameters as before. So the CCI breaks above its moving average, which it did there, but you'll notice it's fallen off again and it's gone down. So what we do is when the price goes against us, if we caught out in that situation, we say the new price is, we enter when the new entry parameters are met. So you can see here the CCI has broken above its moving average and the moving average is going upwards. So that's the first parameter. But we also say the average high-low range of the last 90 days, same as our exit close parameters, the high-low range of the last 90 days is also met. So it must drop by about, what do we say, 14% roughly. So we're saying it's dropped by at least that much, and our entry parameters are met. We enter another lot of shares, another $2,000 lots, and that's what that means. And a new average price is now somewhere in the middle there, between that entry price and that entry price. So a new average price is somewhere there. Now, because our new entry price is somewhere there, our third lot of shares is entered there because our entry parameters are met, and it's dropped by another 14% from that new average price, and that's why that third entry is made. Now, I want to explain something very critical. You'll notice here I've got a weekly time frame. Now, again, this is entering in the number of shares and averaging down without applying any other filters. So we're saying it's dropped by that 14%, which we calculated, and that's where you would have got that drop and multiple entries made throughout this period. But notice something here. On the weekly time frame, you're applying the CCI350. We only want to take trades, these long trades, where it's green, where this moving average is also green. And I should apply a moving average to that. And that's the so you can see there it's going up. So you can see there when it breaks above, and that's back here. So that equates roughly to, I'll draw a vertical line. So that's the upward swing, and a downward swing ends there. So I'll put another vertical line there. So that's it. That's where you would take long trades on a daily chart. And why didn't it? So it would have been somewhere from there, May 2016, and that would have been May 2016 from there until 21 October 2019, and that would have been roughly there. So in summary, you would only take long trades during that period and avoid taking long trades when it goes down. Take long trades during that period and avoid taking when it goes down. Take long trades only during that period, etc. So minimize your entries when, again, you don't want to catch a falling knife. When the price goes against you on the daily, you only want to trade in the direction of the weekly chart. So that's how you would avoid this multiple averaging down if the price kept going against you. So you notice here, we entered the price when it was up here, and the price was going down, or the CCI was going down. You would have entered one lot of shares there, and you would have avoided that second lot of shares, and you would have entered another lot of shares there. So again, to minimize your averaging down, only trade in the direction of the weekly trend. So where does this latest program stack up in our ranking of programs tested to date? So you can see here I've got all these programs, and they're just my numbering system, so don't stress too much about that. But this one here is the latest one I've tested, the CCI350 with a weighted moving average of 100. And I've tested these blue chip shares, and also it shows you the profitability for each of those over the period on a daily time frame. I've tested it against with the drawdown and also the profit over drawdown percentage. So it's simply saying the profit divided by the drawdown gives you a percentage for each of those. So the average profit over drawdown ranking equals the 257% is the number, the percentage number, but the ranking is third overall actually. So it's 292, third overall. So it's actually quite high in our ranking system of programs tested to date. I have tested the alligator strategy and the MACD stochastic strategy previously, so you look up those in the strategy playlist. But today's video and today's strategy ranks third overall in the share trading strategies. You'll notice also I've tested these on a 4-hour time frame as well as a daily, but that's just a different set of programs tested. But if you want to test if you want to run a daily share trading strategy, today's strategy ranks pretty high in our overall scheme of things. Here are some of my investing rules: buy proven blue chip stocks, buy stocks which pay dividends, don't short positions, go long only. And the reason for that is you want to receive those dividends when they're paid, and don't trade on news. Price is already factored in the share price. Thanks for watching. Don't forget to click the subscribe and the like button and click the notification bell to get all updates. Market updates will be posted on Mondays and Thursdays each week. If you want to support the channel further, then subscribe to the Patreon page. The link is in the description below. Happy investing and speak to you in the next video.